We're going to be shifting gears now when moving over to the emerging market space. Now, as you know, the Net Group Investments Global Emerging Markets Equity Fund has been uniquely placed with a high emphasis on combining liquidity and macro and country-specific analysis with a bottom-up stock selection in terms of their portfolio construction. Joining us to tell us a little bit more is Ian Beattie, and he is the co-CIO at NS Partners, and he's also the head of the global EM at the firm. Ian and his team are now approaching their 3-year anniversary at the end of this month, and they've been managing the Net Group GEM Fund. Now, in addition to more than their 25-year track record overall in terms of managing GEM mandates. Ian, thank you so much for making the time to join us today. I know that you've got a presentation prepared for us, so I'm going to hand over to you before we try maybe get a question or two afterwards.
Good morning. Yes, thank you for that. I'm going to go through quite rapidly some backward-looking presentation material here to look at what happened in the last quarter. Then there's some forward-looking analysis and forecasts, and then I hope to leave plenty of time for questions, because I think that's where it gets more exciting, doesn't it? So obviously this is a very, very difficult time for all investors everywhere, with huge changes going on in the cycle. And I'm just trying to make sure my clicker here is working. Right, there we go. So if we go through the performance page, you can see here quarter to date, quite a nasty downturn there, down 10%, which is significantly worse than the index, which is down nearly 7%. Over a couple of years, we're still ahead of the index, showing a much better return, since inception there, but it's still been quite tough going. So if we move on and see what that result was. Quick firm update, but I think we can go through this quite quickly. We're at just over $2 billion in the strategy now, and $5 billion as a firm, and we're continuing to hire people, Michael Mortimer being our most recent hire. So we can go forward to the next one. Here we go. Yeah. So over the quarter, I've got this quite little summary, 3 good, 3 bad as well, to give everybody a quick version of what's been happening. And you can see here what did work and what didn't work. Well, obviously we've had a huge inflation shock globally. And so you can see that's really benefited certain sectors that I'm sure we've seen everywhere in the world. Russia was obviously the massive move in emerging markets. We managed to sell most of our holdings in those before, but we did get caught with a very small amount left on the portfolio at the time of the invasion, which we've written down to broadly 0. We were underweight the GCC and South Africa and some Latin American countries, all of which didn't work. But our underweights in Russia was obviously a positive, significant underweight. And we had good stock selection in Thailand. We had a big underweight in China. We've had that for over 12 months now, and that's obviously been positive, and Korea as well. Our overweights in Thailand and the Philippines were also positive, and we had good stock selection in consumer discretionary and IT still. If you want to pick out the individual stocks, then although we sold Yandex, we owned it for a little while over this period, and that was very negative. HDFC in India, which is a very strong winner for us in the long run, has continued to have a tough 6 months, and that's been quite negative. On the positive side, obviously anything in energy has been great, and we've owned PTT EP in Thailand, which is the upstream exploration and production oil and gas play, which has been obviously very strong, as has the sector. Not owning a large number of Russian stocks obviously shows up as a positive, as well as the lithium play, SQM in South America has been a positive as well. Now, what do we do over the quarter? We've actually started to add to China. We've started to reduce our underweight there. Also, India continued to add a little bit, and in Indonesia. We took profits in Taiwan. We continued to sell Korea. We took profits in Greece and exited Hungary after the invasion of Ukraine. So I can go forward onto the next slide, please. Performance by country, I think we know what many of these are, and you can see here these will dictate how we did over this quarter. The underweight in Russia looks positive, but obviously it would have been much more preferable completely zero there. Brazil doing very well, and that's hurt us a little bit. We didn't have enough in Brazil. On the countries on the right-hand side, you can see South Africa doing very well there, although coming back a little bit lately. And you can see the Korea doing quite relatively poorly as well, a very big cyclical country there in India, industrials. We can go forward. This is the split here. So you can see, although being underweight China was good, the stock selection there more than offset that. Overall, country selection looked good this quarter, but that's probably skewed significantly by Russia, and the stock selection was generally negative over this period, especially in China, although we had a bit of a give up as well in India. I think I'll go on to the next slide as well, please. This is the same thing on sectors. Some of these will be the same as you've seen elsewhere in the world, apart from that energy being the big underperformer. That's the size of those Russian energy names dragging that sector down there in emerging markets. Staples starting to do well, and that's in line with what we think. We're actually quite negative on markets still for another few months or quarters, and so I think it's time for those staples to start doing and defensives to start doing better. Materials leading the way there. And we think that industrials, in particular materials, probably is about as good as it gets for them, given that we see demand destruction and the cycle rolling. So if we can go on to the next one, please. And then we'll probably skip this one in order to leave time for some more questions later. If we could go on again, please. Just a few of the key stocks here. Expanding more on what I said earlier, PTTP, SQM, and the Staples company, Atacadão, all doing very well, very defensive names, and not owning those big Russian names or showing up as the major contributors. The big detractors there being the companies that I've mentioned already. If we can go on again, please. Our style is definitely quality growth. Got a bit less growth on the portfolio given the current market environment, but you can still see it there as a positive. Profitability, however, even stronger there, shows we've got a very strong portfolio with companies that have good high quality balance sheets and good levels of profitability, but not cheap. Go on to the next one, please. So what we've been doing, well, we've continued to add to Indonesia with the financials, but also the telecoms as well. So still playing that financials theme, but starting to get even more defensive with the telcos as well. But there's a very strong story of reducing competition in a number of emerging markets. And that's the same whether it's in India or Indonesia. And so we've enjoyed some good successes there, and we're continuing to play that theme. You can see there also that we're starting to add to China. We've been underweight, but we're thinking it's time that we're quite close to a turning point in China, and I'll come on to exactly why that is in a moment. If we could skip to the next slide, please. And the funding sources for this, you can see there, a bit of profit taking in Korea, a bit of reductions in Korea, and profit taking in Taiwan, and a little bit out of the energy names in Thailand to PTT, which is a different company to PTTEP. But that's just more taking profits and reducing Thailand in general. If we go on to the next one, please. And if we skip again, these are all more and more granular data. So if you want all this information, just ask for the presentation, please. If we could go on again, please. Okay, so here's some macro analysis that we've been doing. Now, our excess money charts basically inform us whether we're in a bull or a bear market, and they'll inform us as to whether the economy is going to improve going forward. Now, on the excess money, both our measures are looking negative. Now, this means that 6-month real money growth is growing at a lower rate than the economy needs. Now, this is negative for markets, and it looks to remain negative throughout the second quarter. If we see inflation peak, then this liquidity environment could improve in the third quarter. But that would probably mean that the economy was slowing. So this is generally negative at this moment in time for all markets. If you look at our other measure as well, the excess money number is growing significantly below its long-term average as well. So both these figures are pretty negative and suggest that financial markets are still in for a tough time over the next quarter or so. If we could go on to the next slide, please. Now, as I said, this has got a good track record. If you look at equity market returns, when you get these double negative excess money signals, then you can see that historically we are in a bear market in those these sort of environments. If you look at emerging markets specifically, you can see here that they actually look relatively cheap. Whether you look at the dividends or whether you look at the PEs, they look very cheap relative to developed markets. If we can go on to the next slide, please. Now, the big question then is on China, because that could turn around the picture for the whole of emerging markets on its own, really, and be a good boost for the rest of the world. And we actually see signs of encouragement in China, but there's some big caveats. So to show you how significant the caveats, the negative caveats are, we are still underweight China. Normally, if we saw numbers like this, we would be moving to neutral or overweight. All we've done is reduce our underweight. And basically, most of our macro data was improving. Our all-important liquidity and money numbers were improving, but the recovery has been modest. And we've got Omicron variant of the coronavirus surging in some Chinese cities, leading to another lockdown, a very draconian lockdown. And we also have still, I think, relatively high levels of political and regulatory risk, although we may be seeing those peak here. Now, if we get both of those improving again, then this will be quite a bullish picture for China. Not unambiguously bullish or strong, because these factors are and will impact the economy and the market prospects. But if they're peaking here, then China could be set for a period of outperformance. So we need to see some more data, but this is what we're watching out for. And you can see in these two charts that we have seen some improvements in those numbers. You can see the money supply numbers, the light blue line, improving on the left-hand side, and on the right-hand side, you can see there's quite significant improvements there, although probably more is needed because inflation is starting to pick up in China as well, although nothing like the numbers that we're seeing in the rest of the world. If we could go on to the next page, please. Now, one of our more controversial views is the global stock building cycle appears to be peaking, and that usually means that commodity cycles peak as well. Now, that doesn't mean every commodity cycle will go down. They're going to reflect individual supply and demand characteristics, in individual cases of supply and demand for each commodity. But as a block, the industrial ones certainly usually peak with the industrial cycle, with this stock building cycle. And that has all the hallmarks here of starting to reduce quite dramatically. Go on to the next page. And that would tie in with our liquidity analysis. Now, on the cyclical side, you can see here that emerging market cyclical sectors seem to have held up better than developed markets. Developed markets are starting to lead towards this sort of cyclical slowdown that we've seen. And I think, as you can see by our sector positioning, we think there's a good chance that will happen. So we're trying to get ahead of that by looking at more defensive sectors and less of these cyclical materials and commodity ones. Real money growth in emerging markets is holding up better than in developed markets. But the real big one is obviously that China one. We need a bit more data on that for us to get more constructive and more bullish. I think that could be a good place if we go on perhaps one more. That might be a good place for us to pause for questions, but this is a summary bullet points here. Global industrial momentum, we expect, will weaken into the second half of the year. We still see the liquidity conditions as being unfavorable. We've run out of excess liquidity that has driven a number of bull markets over the last few years. We're expecting the demand slowdown to cool commodity markets as a block. That's not going to be for every commodity. Emerging markets do look cheap relative to developed markets, and real money growth is starting to be higher in EM than DM. If that happens in China as well, as it looks like it's starting to, but it depends on how they deal with this latest coronavirus outbreak, then we will have the conditions for outperformance in emerging markets, but I'm not calling for that just yet. Still waiting for more data on China, really. So we're underweight and not positive on some of these cyclical markets and sectors and countries. Whereas everywhere else we're starting to get more constructive, but it might take another quarter or so. Thanks very much. And now I'd love to hear some questions where I won't need my tech.
Ian, thank you so much for that, and really some great thoughts there around China, and yes, just waiting for more data. I think everybody was wanting to see where you would be positioning yourself and what would tilt you to maybe move to a neutral position or overweight position, given that you are looking to close that underweight position. I'd like to just make reference to two particular stocks and maybe even a region. You make reference to two Vietnamese stocks, and that is Vietnam Enterprise and Vinhomes, and these of course are off benchmark positions that you currently have. But maybe if you can just give us a bit of color around what is so interesting around these particular companies, and perhaps what makes Vietnam at the moment more interesting than other frontier markets.
Yeah, Vietnam has some very strong fundamentals. Basically, its progress along the development ladder seems to be relatively smooth over the last 2 decades. We've been investing in there for a very long time, so we feel comfortable with the assessment of the risks as well as the rewards. There's some very good companies there. There is a pretty good level of governance relative to its level of development. So we're not going to hold Vietnam to the same level, same standard as Singapore or the US, but it's pretty good for where the wealth of the people is. It does need to improve, but it's not lagging behind where it should be for this level of development. All these things are very important in the long run. Monetary conditions look good, and it is taking market share in manufacturing here. You can think of it as the new China. Now, it's very easy to say, oh, it's very small. It's actually quite a large population, and it's growing really fast. It would be a large country by European standards. It's only because it sits next to China and in between these other great East Asian giants like Indonesia that we tend to think of it as a smaller country. It's actually quite a large country by other standards. Growing really fast, reasonably stable financial system, relative to its level of development. It seems to be cheap. The market is cheap. Earnings growth is strong. It ticks a lot of boxes, basically, and it does seem to, as people are diversifying supply chains, they're moving to the next place to set up your production plant. Vietnam is a natural successor to China. And we saw a few years ago Samsung set up a huge plant there to manufacture a lot of its handsets. So I think it's pretty well set at the moment. And of course, it could be the next country to be promoted to the emerging markets. I don't really want to only invest in a country when MSCI tell me I can. It'd be good to get ahead of perhaps that sort of announcement.
Ian, just going to try and get one more question in. In the beginning of the presentation, you mentioned the inflationary shocks or the pressures and how that filtered through to, the emerging markets. Just very high level, are you able to maybe tell us about what you think some of the most vulnerable countries are at the moment in terms of emerging markets? If should we continue to see these, inflationary pressures become more pronounced?
Yeah, it's very interesting because China's taken a very different macro stance to other countries, both developed and emerging. If we're just talking about energy price shocks, then the emerging markets are pretty stark. You've got some energy exporters and you've got some energy importers. So Thailand, Mexico, Brazil, they gain as much as they lose, or perhaps they gain even more so. And obviously the GCC and the Middle Eastern countries. China and India are the big energy importers. And so they're technically at risk on the energy price side. But with some reforms that India did a few years ago, and to be fair, to a certain extent, China as well, then they're less vulnerable than they were in the past. The government will not be subsidizing some of these prices like it did in the past. So you won't get the double hit of it hits the economy and it hits the fiscal balances. So India's got its house in order, as it were, during the good times. And I think it's reaping the rewards for that now. Much depends on what happens next. So if this is the peak, then China and India will do relatively well going forward as these prices come down. Although China is a food price importer as well, but much less again than it used to be. So you can see why these countries are not distancing themselves from Russia like the West basically is, because they need the food as well as they need the oil and the gas. Other emerging markets, both in South America but also in East Asia, are soft commodity exporters, and that's obviously doing pretty well at the moment. So they're gaining there. Generally, emerging markets used to do well when commodities were firm. So we're not too worried, but we are very nervous about the energy price in particular for a few emerging markets. I'm more worried about the secondary impacts of what the Fed does, and does it tighten even more in order to counter this, because that will impact those emerging markets that have current account deficits. And so I'm a little bit worried about, as we run out of excess liquidity, as the Fed tightens and the dollar strengthens, that will impact the more vulnerable, the more fragile emerging markets that have current account deficits. So we're a little bit wary of both companies, but also countries that need other people's money. If they need other people's money, then this could be quite tough over the next 6 months for them.
Ian,
That's a problem that China, Taiwan, Korea, and many of the Southeast Asian countries do not have, as they are in good shape on their external balances.
Ian, thank you so much for that. Really very much appreciated. Thanks for that great presentation. Of course, that was Ian Beattie. He is from NS Partners, and he mentioned a couple of things there in terms of monetary policy.